S&P 500 continues on its move to the upside at the time of recording this video, up 0.26% on the day. Now, starting tomorrow, you have some larger company earnings that will be very important for the markets, but really tomorrow and after hours, you get Google and Microsoft, and that is going to be the first round of major market cap that will be reporting earnings. And the more we rally into those earnings, the harder drop that we could potentially see. So the fact that we are green today is actually quite worrying for me. It's like if you sell off into the Fed meeting, every time throughout 2022 that has happened, you have bounced from that low before the Fed meeting. But if you rally into the Fed meeting, you pretty much always drop. Same thing with earnings. Snapchat rallied 15% into their earnings. Well, what happened? There was very high expectations. The price of Snapchat just went up a lot, so there was more meat on the bone to push that stock back down. Now, if you guys did not watch the last video I put out, I am very concerned about Apple earnings. We will touch on that here in this video, but there is some things in Europe that are happening today that is very, very concerning. So let's get into all of this key information. The first thing that I want to point out is that ECB Lagarde came out today and said that they will raise interest rates as long as it takes, pretty much saying no matter what happens, we are going to raise rates to get inflation down. Now, why this is so bad, if you guys don't watch the channel, ECB is known for being too late to raise rates and raising rates too aggressive into slowdowns. This happened during 2008, the eve of the financial crisis, the night of the financial crisis for America. It was daytime over there. They raised rates. That helped to push the global economy into a recession, at least Europe and that side of the world even more. And what happened 3 months later? Well, the ECB, the world was cutting interest rates. So they were way too late to raise rates, and they raised rates when they really shouldn't, to be honest with you guys. But then in 2011, the same thing happened. They raised rates more than expected. And then what happened? The markets dropped about 20% over there for Europe, and the markets over here also dropped about 20%. Let's go to 2011. Right here. This was all from Europe raising rates 20% from peak to trough, and then we pretty much bottomed right at 20%, and then we did make our way higher. Well, what's happening now is that you have all of these external factors that the ECB, the Federal Reserve, cannot control, like energy and food prices, that are really starting to hurt economic growth, that is pushing Europe into a recession, if not already in a recession. In America, well, we will be in a technical recession on Thursday, but don't let that fool you. The White House is trying to come out and say that even if we get a negative Q2 read to GDP, it's not technically going to be a recession. You guys can see right here, this is all playing the good old politic game for the midterms. They're trying to change the definition of a technical recession. So I think that's pretty funny. Wanted to point that out. But the main news of the day that did cause the S&P 500 even at one point today to see a very big red candle. Well, what caused that? That was Europe and Russia, and I believe that candle was right here. That was a 0.27% candle. That was a 1 point move on the SPY, dropping about $1.05 in 1 minute. It's because Gazprom, which is fully owned by the Russian government, says new turbine halt will further cut gas to Germany via Nord Stream 1. And what they say right here is Russia's Gazprom said on Monday it was halting another turbine in the Nord Stream 1 pipeline to Germany, and the flow of gas, already at just 40% of capacity, would fall by another half from Wednesday. So what that means is by Wednesday, they're going to be at 20% capacity, and that is not enough to support the European economy to keep Europe warm during winter. And that's the real pressure here. And that's what Russia's trying to do, is say, hey guys, if you take off some of these sanctions, then we will make sure that Europe does not freeze to death over the winter. And a lot of economists were calling for a potentially 20% drop just if Russia did not turn this pipeline on. It's only 20% on right now. It's one flip of the switch away from going off and turning into a really, really bad event for Europe, which would translate into a bad event for the Americas. Now, if we look at the earnings lineup, Tuesday, pre-market, UPS, Coca-Cola, GM, GE, McDonald's, Raytheon Technologies, Kimberly-Clark. Think about the industries here. So if you have trades on restaurants, that's going to be affected tomorrow morning by McDonald's. GE, you could fit that into its own category. GM would be vehicles, right? EVs, all of it. It will be affected by GM earnings. Coca-Cola, that's more the consumer, Coca-Cola sales are pretty relevant, and they kind of stay the same. They don't really grow too much. They don't really decline too much. But Coca-Cola, that will affect Pepsi. That will affect distributors of different, beverages and food products. Think about food when you think about Coca-Cola. Now, UPS, that's obviously going to affect Amazon. That's going to affect delivery, things in general. So services, consumer, potentially demand destruction with the GM report. We'll see what happens. Different industries will be important there. Now, in after hours tomorrow, you have Alphabet, better known as Google, Microsoft, Visa, Enphase, Chipotle, Texas Instruments, Skechers. Now, with Visa, you get a much better read of the credit in America. How much of credit cards are being used? What's the credit usage? How many people are signing up for credit cards? What do balances look like? Things like that. What are spending habits? You're going to get all of that from Visa. From Microsoft, you're going to get the business side of things. You're going to get the cloud, business, right? Azure, that's the thing people care about when it comes to Microsoft. Microsoft, a little bit more insulated from what we're seeing right now in the economy, in my personal opinion, but Google could be the one that really does take a beating with this earnings, even like we seen last time around, last earnings. Google dropped 10% just because YouTube revenue missed a little bit. So you want to hit that like button and subscribe to the channel so Google does not miss and your calls might print because of it. Nah, just playing. That's not going to affect anything. But that's what we have for Tuesday. That's really the first round of big market cap stocks that are going to be reporting earnings. And these are what the markets care about right here. Tuesday, Wednesday, Thursday. More so Tuesday and Thursday, but Facebook, Shopify, Boeing, Ford, Spotify, Qualcomm, Waste Management, Teladoc, Etsy, ServiceNow, QuantumScape, Sherwin-Williams, Kraft Heinz, Bristol-Myers Squibb will be important too. But really, Alphabet, Microsoft, Amazon, and Google, those are the stocks that are really going to either help things out or hurt things a lot. And as you guys know, about 20% of Apple's revenue comes from China, and about 25% of Apple's revenue comes from Europe. And what we're seeing over there with consumer confidence and the spending numbers, look right here, just off a cliff for consumer confidence and consumer spending. It might not translate into the best earnings for something like Apple, and that's something I'm pretty concerned about, and I did go over those concerns in the last video, so we're not going to touch on it for all too long, but it is important to point out. Now, for tomorrow, we are going to get new home sales. The S&P Case-Shiller Home Price year-over-year index. We're also going to get Richmond Fed Manufacturing, Dallas Fed Services, Richmond Fed Services, a lot of that kind of data. It's not really going to move the markets all too much. This is really earnings season. New home sales for June, that could be the one thing that does move the markets a little bit, but I don't really expect it to. So there you guys have that. That data comes out at about 10 a.m. You also have the yield curve that is still inverted 21 basis points. So this is still the longest yield curve inversion that we have seen in a very long time, and it does not look like it's moving around all too much. And if we look at the Atlanta Fed GDP Now estimate, we're expecting a negative 1.6% GDP print for Thursday. We get the Fed on Wednesday. Worst case scenario, Fed comes out and they just give us the same old guideline that they have been giving us. They're going to keep raising rates. Inflation's too high, or potentially signal they need to raise rates a lot more after this last CPI report. Or they could say, yeah, we're going to take a pause. Taking a pause, slowing down, raising rates is a very bullish thing. So keep that in mind. That is the single most bullish thing that we could get as of right now, besides, Russia and Ukraine, that fight being over with. Those are the two most bullish things. Russia, Ukraine doesn't look like that's going anywhere anytime soon. The Fed, that's really the question here. I personally don't think that they will give us that indication that they're going to slow down raising rates. And I think if you go into a technical recession with the Fed and with bad earnings, well, that's a recipe for, a 2, 3, 4, 5% down day in the stock market and continuing down another 10, 15, 20% from that moment in time. So I think really today is a big chill out period, and I think that's what people are really doing today, is really waiting for earnings. You're going to see the most violent moves that you have seen in a long time coming around earnings and in the S&P 500 after those earnings do come out. Now for Wednesday, as you guys already know, we're expecting to get that 75 basis point rate hike, about 76.9% already priced into the markets. And we don't have a Fed meeting for August. So that's something people are talking about, that's saying, hey, the Fed might signal that they might slow down in September, because that's, months away from now, right? We don't have a Fed meeting for August. And that's possible, but I really just don't think that's going to be the case. I think if anything, Fed Powell avoids any kind of guidance for September. I think he just wouldn't want to do that. He doesn't want stock prices to go straight to the moon again. He doesn't want people to start spending more money because they feel richer, because their portfolios are now doing well. I don't think the Fed wants that, and I don't think that's what they want to happen in the stock market. So there is pretty much all of that. The S&P 500 for the day, you could see positive order value is sitting at about 82%. 2,025 orders totaling $189.82 million. You're seeing a lot of call options come in for the day, so I think that is really helping to balance out some of the negativity that you're probably seeing with hedge fund shorts, because at this point, if you're not trying to protect your portfolio heading into the rest of this week, then what are you doing? Because the stock market is up, let's go ahead and roughly 9.5% from the lows that we've seen, and something like Apple's even up 20%. When Apple controls 7% of the markets and you have 73% of the total weighting of the S&P 500 market cap reporting earnings this week, you should be taking some downside protection. So there's probably a lot of short positions on the markets going on today, and that is probably keeping us pretty low on the S&P. Those short positions, as well as the call options, probably helping to offset each other just a little bit, and that is creating a weird market today, honestly. Now, as far as the total open interest for options for this July 29th expiration, which is this Friday, you have calls sitting at 27.47%, so not a lot of call activity comparatively to puts. The puts is sitting at 72.53%. So there's a lot of negative positioning for this week, and I think that's probably ultimately what we are going to get. And if this week is bad, if we get bad Fed, if we get a technical recession, if we get really bad earnings, well, you are coming down and you are hitting newer lows in the S&P 500. It's going to look a lot like this, where the market's lost 2.38%, then the market's lost 2.9%, then the market's lost 3.8%, then the market's lost 1/3%, and then we kind of, just trended down a little bit more, found that bottom. But this is what the markets would likely look like if everything just goes wrong this week. You could probably drop 10% in 4 trading days. That's a very big possibility, and that's what happened back here the beginning of June. So that is pretty much going to be all. If we do see, good earnings, if we do see a Fed that relaxes, if we see, us avoiding a recession, or maybe it's a very low reading, maybe a 0.2% negative GDP print, well, what I would target to the upside is about 425 to 430 on the S&P 500. I doubt we break out above the 200-day moving average and go into another bullish trend. I highly doubt that, and I think right now is the time to try to protect your portfolios after we have seen a very sizable and respectable move from the lows of 2022. So that is going to be all for this video. Hit that like button and subscribe to the channel, baby. If you guys have not already, what are you doing? It is free 99. The only thing that has not went up with the price of everything else. Shout out inflation, shout out young Biden. Get yourself free stocks down below in the description with Webull, Moomoo, and Public. It is free 99. Deposit any amount into Webull, Moomoo, and Public, and you will get up to 10 free shares with Webull as well as Moomoo. So that is 20 free shares just depositing $2, $1 into each. So take advantage of that while that does last. Who knows, financial times, you know, we're not living in the most robust financial times, I should say, right now. So who knows how long those sweet promotions will last. Take advantage of it while it's here. That is it. You guys enjoy the rest of your day, and I will see you in the next one.